if you can share your goals with someone, if you can ask someone to be your accountability partner, if you have regular scheduled check-ins, I think that's a really good way of doing it and offsetting that. That should be a really easy one to fix. So if you're serious about, what you're doing in your financial strategy and your financial plan.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Welcome back to another episode of the 360 Money Matters podcast. I'm Billy, and I'm joined by my co-host,
Andrew. Bills, here we are back again like the Backstreet Boys. I'm pretty sure I've used that one before.
Favorite time of the week. I don't know if anyone else is laughing from their end, but we definitely are having a bit of fun here. So
as long as you're entertaining us, so
that's all it counts. Andrew, what are we talking to everybody about today?
So today we're going to talk a little bit about why most people's financial plan fails within 12 months and how they can avoid it. Now, this is, hopefully why their financial plan fails without having an advisor. So why your DIY plans fail, maybe. But no, in all reality and in all honesty, it's really looking at why people don't follow through with what their financial plan is.
Yeah. That was a question that I was going to ask, to make sure that we put that caveat in there, that this is...
Well, if you've got an advisor, then there's something seriously wrong with this failing within 12 months.
I think the first thing, and this one is blatantly obvious once we call it out, but too much complexity. So it's the same as almost anything that you apply, right? You want to learn a new skill or lose some weight or get fit or do some exercise or what have you. If you stack too much into it and there's too much complexity, it fails because it becomes overwhelming, which then leads into inaction. And, I'm sure we've all said with a whole range of different things in our personal life, but you bite more than you can chew, and you don't do anything, and you don't do anything really, really well. Easier said than done, but a way to fix and address that is to just pick one or two things at the start, get those embedded, do those things right, and then move on to the next one. Yeah, I think that's really the simplest way. But yeah, too much complexity will kill it each and every time.
Yeah, and I think, like to give a bit of an example around it, debt recycling is a strategy that we know and love. Right. And so for the right person and for the right circumstances can be a really, really powerful strategy. But you're not normally going into a debt recycling strategy first thing off the bat, the moment that someone comes to see you for advice, because it's, hey, let's just start investing first. If you've never invested, if you've never put money into shares or managed funds or ETFs or anything like that, and you're trying to go down a debt recycling, which is that incorporating debt and using a portion of it to pay off owner-occupied debt, it's a lot. And so normally it's, take the first step, understand that, get that under your belt. Yes, there's going to be a little bit of missed time by, not enacting it at this very moment, but that's okay. That's going to save you from not doing it at all because it's just too complex up front. And so sometimes sometimes the right thing to do is just simplify what it is that you're doing with your strategy in order to be able to just take the next step. And then you build on that, and then you build on that, and then you build on that. And, by the end of it, in no time, you're there, as opposed to just trying to do too much all at once.
It's a really good conduit into the next point about no clear first step. Yeah. And like anything, the first step is usually the most crucial as well, too. So if you don't have a plan and what comes first, because there is some merit in having the right sequencing associated with the financial strategy and a financial plan. If you don't get the first step right, there's no clear first step, then you're going to struggle with your momentum. It's like putting I don't know why these analogies come to the line. Kids are doing a jigsaw puzzle. It's like doing a jigsaw puzzle without doing the border first. If you don't do the border first, then good luck. You're never going to get it done, right? So,
I'm going to add on that and say, first, second, third, and more just when you're talking about investing. I think a lot of people think, I'm just going to invest whatever, an amount of money. I'm just going to invest 10 grand. I'm just going to invest, 50 grand. Or I'm going to do something, and not having a direct debit and something to be, all right, this is step 1, 2, 3, and, this is how I build, as opposed to just, I only look at it when I look at it, and when I make a decision, then that's it.
Yeah, and I think, look, the other thing too, I mean, we're talking about this situation where there's no expert involved in that process. And the truth is most people don't know what they need to do at what particular point in time. So it becomes difficult, even if you are, doing stuff and executing, you may not necessarily know what sequence to do them in is the most optimal. So from that perspective, what we say is define your action that's, going to happen on day one, start with that, execute on that, then move on to the next thing.
Yep.
Rinse and repeat, so on and so forth.
Yeah, exactly right. Will's not having support around the implementation of a strategy, I think is another, really big key. It's all good and well to have the best laid plans, but without having a clear, defined implementation strategy to actually execute on those plans, it's meaningless. And we've probably got hundreds of examples of this, but I'll talk about one because it only happened yesterday. I spoke to a client pretty much this time last year, and we were talking about a recontribution strategy, sort of around pulling money, or pulling money out of super, putting money back into superannuation, and executing on that, and that was going to result in a 15 grand tax benefit to that month by doing so. Anyway, there was obviously a fee that was involved for us to deliver the advice and implement. And he said, "Oh yeah, it sounds pretty okay. Like it's all good. Thanks for the conversation. I'll implement on my own." Okay. Obviously we talk about some of the risks that's associated with it, and contribution caps and complexity and all of that stuff. Fast forward to 12 months later, and that client is back in our office yesterday. And he's having a conversation that's exactly the same with me around, okay, well, I didn't actually do what, we were, or what you suggest what we do. And yeah, I think it's about time that I, actually pay you and get you to implement and, go through the actual strategy off the back end of it. And okay, that's fine that you've recognized that, the mistake that you've made in the past, but you're 15 grand worse off.
Yeah.
Like you've quite literally missed out on, all of that over the course of, and, you compound some of the investment earnings and all of that stuff off the back end of it. But, all of a sudden you've lost a year in a strategy where you've got a pretty short window of how many times that you can execute on this strategy. And so not having, implementation support and not having an implementation plan is, another reason why a lot of plans fail.
Yeah. Behavior of the person most of the time is greater than the strategy, right? So we'll give a perfect example of that. But you might have a really robust strategy in place or a plan, and then your behavior gets in the way. So as an example, what we're seeing at the moment is a lot of noise around the world in terms of what's going on with the Middle East. We're seeing markets, jump up and down. You might have a really good strategy, but if you respond to that negative news and you can't necessarily look through it, then you might, abandon your plans. You might sell at the wrong time. You may deviate from your strategy, make a mistake, I don't know, trigger some caps, trigger some tax, sell at the wrong time. It's just, things get in the way. Life gets in the way as well too. It's just your behavior. You're your own worst enemy from that perspective. And you may think that may not have the consequences at that particular point in time, but when you look back on it over time, you might turn around and go, "Oh, geez, I should have stuck to the original plan and the original strategy that I had." But the human element, the human behavior, and staying objective when certain things are happening around the world, and all you're seeing is negative news, it becomes very, very difficult to see through that and stick to your guns because it turns into emotional decision making. Yeah. So I think the way that you offset this, knowing that it's going to happen, because we do experience things as humans, whether it's in the market, whether it's in our own personal lives, you almost build these rules in a period of time where you're not experiencing that pressure, and say, okay, regardless, this is what I'm going to stick to. If the market drops by 10%, my reaction will be X. Or if my income increases, this is what we're going to do, Y. Or if I lose my job, this is what we're going to do. So you've actually gone through that planning without pressure of it actually happening, and you can make an objective decision before the fact. And if it ever comes true, you go back to your strategy and you go, okay, this is what I had written down and said that I was going to do. This was the right answer then. This is the right answer now.
Yeah. And I think, building on that, or maybe a cautionary tale sort of within that as well, is build your plan based off your circumstances now, not based off, to use your example, some people will say, I'm not actually going to invest until the market falls. And that's not a plan, that's not a strategy, and that's not something that's ultimately going to get you anywhere at the end of it. Same as, I'm not going to invest until my income increases to Y, because that's going to give me the cash flow. But build your plan based off your strategy or your circumstances today. And if there's opportunity to grow that, if there's opportunity to do more, then fantastic, do it. But don't not do anything until something happens, because usually what that means is that you're just missing the opportunity and you're sitting on the sidelines.
Yeah, absolutely. Andrew, another reason why most financial plans fail is there's no accountability. No accountability. Someone's not checking in on you. Someone's not holding you to account. Your priorities shift. I love using the gym analogies, but it's exactly the same, right? They turn around and, in terms of human psychology, that if you can share a goal with someone, the probability, and I don't know the numbers, but the probability of somebody achieving it is higher because you've shared that. And if you've got somebody like an accountability partner, the probability of hitting that increases quite significantly. I think life just takes over for most people. That's the reasoning that we see why things don't get done. In terms of how do you prevent that from happening, if you can share your goals with someone, if you can ask someone to be your accountability partner, if you have regular scheduled check-ins, I think that's a really good way of doing it and offsetting that. That should be a really easy one to fix. So if you're serious about what you're doing in your financial strategy and your financial plan, get somebody who's going to hold you to account. The easiest way, and obviously flying our own flag here, the easiest way is get an advisor, and they'll make sure that staying on track. But one of the reasons why we see plans fail is because there's no accountability, and it's easy to kind of let yourself off the hook.
Yeah. I think another one sort of within, not sort of within that, but sort of to close things off, is just not or trying to be perfect as opposed to consistent. And trying to time the market, for instance, is a perfect example of it. You're trying to actually find the bottom of the market before you actually buy in. And I'll use property as an example because it's an example that everyone knows and loves, particularly here in Australia. Is people have been talking about property in Melbourne and some of the opportunity that is very likely to present itself from a value perspective. Okay, now all of a sudden there's talk of interest rate rising, and there's talk of some conflict in the Middle East and rising costs around fuel and what impact that's having to your own circumstances. All of a sudden the conversation is now changing, and people are, maybe it's going to drop more. Like maybe there's going to be an even better opportunity. And I'm not saying go out and rush and buy property in Melbourne. That's not what I'm trying to say. But if your plan is, okay, this meets my circumstances, this, fits into my overall strategy, I've got the cash flow to be able to do it, I've got buffers in place, I've got a risk mitigation strategy, and this is what's going to take me to the next step in my financial planning journey. Trying to wait to find the bottom of the market as opposed to just buying in at a discount is a plan to fail, because you're not going to be able to time it absolutely perfectly. And being consistent around acquiring assets and being consistent around this is my strategy and this is what I'm trying to do is the only plan that leads to success. Same with the share market, trying to find, now's not a good time to invest. Maybe we'll just wait until things recover a little bit and then I'll buy in. You're never going to buy back in, because then when the market goes up, it's, the market's just gone up. I'm buying everything at high prices. I'm not going to buy now. and then the market drops and you're in this same cycle. So being consistent, dollar cost averaging, still being considered and measured around when you are investing and, is it actually right for my circumstances? But it's just progress over perfection.
Yeah, and I think that perfectly comes back to what we were saying before, that behavior is will have a greater impact than your strategy, right? So if you think that you need to be perfect and you want to try and time it and optimize it, you might miss it, you might make the wrong decision, you might delay it, and it'll have greater consequences down the track.
Controversial opinion, you may get it right, and that's going to lead to you then trying to do it every single time after that, because all of a sudden you've done it once, you've timed it perfectly, and I'm going to do it again. And lightning doesn't strike twice. And, I've seen some incredible investors and they haven't been able to time the market perfectly. So what's the likelihood that, Joe Blow down the street's going to be able to do that as well? Probably not. And maybe you got lucky once and that's given you a false sense of security. So, the likelihood you get caught again.
That's how people turn into problem gamblers. They strike it rich once and they think they've got the magic formula, and before you know it, it becomes an issue. Andrew, one of the things from my end is no connection to personal goals. So I'll give you an example, right? Like with a lot of financial planning, a lot of financial analysis, you're in a spreadsheet, you're doing projections, you're thinking about what the future holds and what have you. It can feel quite disconnected to the goal that you're trying to achieve. So rather than thinking, okay, I'm in a spreadsheet and it doesn't feel real or I have no connection to it, there's low emotional buy-in. The solution to that is think about the reason why you're doing it and think about that future goal and then kind of bring it back. So as an example, oh geez, we're investing $100 a week or whatever it is. It doesn't feel like anything, or, what's the point? I can't see it or can't feel it. But if it's like, hang on a sec, no, this is going to fund your kids' education, that becomes much more personal, and you're attaching the activity to the actual outcome as opposed to getting stuck in the details, in the weeds. Another example is, I'm doing all of this stuff. I'm working day to day. I'm paying all of this money into super. Like, what am I doing? I feel like I'm on a treadmill. Well, hang on a sec. You could be doing that because you're going to retire early, or you're going to retire with a certain amount of income. So then you can stop working and make sure that you can have enough money to fund your lifestyle to live the life that you want. So it's trying to, yes, recognizing and understanding that there are details that you do bury yourself in the spreadsheets. How do you extract yourself out of that from a thinking perspective and go, okay, I want to focus on the goal, and I want that to be my
use the goal as the anchor point.
The anchor point of kind of like the North Star, and say, okay, this is what we're aiming for. This is what we're going to achieve. But these are the things that we need to do in order to do that, and not to lose sight of that North Star.
Yeah. No, I 100% agree. And you see that, that's what people, or that is what causes people to actually follow through on, a goal is when they're anchoring it towards, this is what I'm actually trying to achieve.
And it helps you stay consistent.
Yeah. And look, it reduces the likelihood of, because it takes, especially in this day and age, it takes a moment. Like, it does not take much to derail, something that you might have taken years to build up for, right? Like, it takes one moment of saying, I'm over just contributing into this.
Yep.
And I'm feeling like I'm not getting anywhere. Or it takes one moment of, the markets are low and, Trump's going to blow up the world. And so let's, sell everything. It's one moment to say, stuff it, just sell. And you make that decision, it's done and it's irreversible. And so the, mental fortitude that it takes to not do that over the course of 30 years is large. Whereas when it's anchored to, okay, this is what I'm doing it for. It's covering my kids' education, or it's giving me the option to, finish work 50, or it's much more likely that you're actually going to follow through with it.
Yeah, completely agree.
There was a thing to, close sort of all of this off. It's most of the time, sometimes people have some really bad ideas, but most of the time, it's not the idea or the plan or the strategy that's wrong. It's not that people aren't, putting together, or it's not that you're not thinking about things incorrectly around sort of what you should be doing. Most of the time, it's that things are just not getting implemented, and all of those strategies aren't actually, coming into fruition, or that you're just not maintaining it and being consistent with it and removing some of the think work and the friction of actually taking action. So I think that really it's just a matter of, okay, making sure that your plan and your strategy is, simple, understandable, that you can, execute on it and there's a plan to execute, and that you're keeping on track and that you're monitoring it and, giving it life and you're, giving air to the fire in order for it to be able to continue growing.
Yeah. Now, Andrew, well said. Hopefully that one gave everybody a whole heap of ideas around why financial strategies don't work.
Yeah.
Or financial plans don't work.
Yeah. And hopefully that gives you some insights around how you make sure that that's not you and that, your plans are followed through and that continues to, feed into your own financial goals and what you're trying to achieve.
Or if it was too difficult to go through all of that, just get advice.
Yeah, just reach out to 360.
That's it. Andrew, thank you.
Bills, thanks again for another great podcast. Thanks to all of our viewers and our listeners. If you did get some value, we'd love it if you could like, subscribe, and we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.